both of you have gone as far as like having a YouTube channel and creating content and creating videos. I'd love to know just firsthand how that's affected your business and helped you be successful.
Basically, all we're doing is giving a little bit of information here, and then someone that really wants to know about it would probably next dive into some videos on the YouTube channel. And we do have some other social media as well, but those are the main two
Andres,
that people tend to
I would
gravitate
say,
to.
your generation, you guys barely know what a phone book even is, right? People are not going to the phone book today. They're going to Google, they're going to YouTube. This is where we're consuming our education, TikTok and Instagram. So the business owners that are listening to this.
Welcome back to another episode of the Beyond the Wealth podcast. I'm your host, Andres Sanchez, and today we have Stephen and Barry. We're going to dive into everything around estate planning, building wealth, saving and keeping that wealth long term, and overall just giving yourself an amazing life down the road. I think there's going to be a ton of super fun topics for us to talk about in this interview. And me personally, being on the younger side and wanting to build wealth and stay wealthy, there's a ton of natural curiosity for me here as well. So guys, I'm so excited we were able to make this happen. And thank you both for carving out the time.
Yeah, thanks for having us. Yeah.
Glad to be here. Thank you.
Let's let the people know who you both are. We could start with Steve and then go to Barry, and we will take the conversation from there.
All right. Sounds good. So I'm Steve Gibbs. My background is really as a trust and estates attorney. I ran my own practice in Florida for about 15 years, helping people set up basically wealth protection strategies on the legal side. So setting up trusts, setting up LLCs, protecting nest eggs, protecting businesses, corporations, you name it, and trying to knit together the different components of an estate plan. And those can differ depending on what somebody's doing and what their goals are. So we can touch on that, Andres. But what I think we're going to end up talking about is we're going to talk about how another trust attorney friend of mine and I in 2018 started insuranceandestates.com, and what that was a takeoff from my years as a trust attorney. But I wanted to help bring a platform to life that was going to bring together permanent life insurance strategies with the trust and estates portion of it. And I could see that being useful to consumers because you got these two areas that naturally run together. And from a web standpoint, see your generation coming up, I could see that, years ago, and we could see the value of that. People being able to come and pursue maybe their basic estate planning, and also look at how permanent life insurance and these assets that we're going to get into, call it the ultimate asset, is going to knit together with that plan to provide some really great advantages. So that's the background. That's the start of Insurance and Estates.
I love it. I will kick it over to Barry.
Yeah. Barry Brooksby. I've been in financial services for 25 years. And what's crazy, Andres, is when I started, I was putting people in the market. I had this mentor that trained me to put money in the market, and he was telling me that my clients were going to earn these 12 and 18% returns every year. And I thought, wow, this is amazing. Let's do this, right? But a year into that, my clients start calling saying, Barry, I'm not making money or I'm losing money. What do I do? And my mentor said, hey, just tell them they're in it for the long haul. And I couldn't keep going down that path. That didn't set right with me. So today I own a company called Focus Wealth Group. Steve and I, our companies work together. We have clients all over the country. And what I help people do mainly, guarantee their returns on their money. So they're getting guaranteed growth every year. They have access to liquid cash. And then amazingly, all this money comes to them tax-free. I love what I do. We help people primarily grow more wealth and pay less in tax. That experience 25 plus years ago, it propelled me to find something better. And that's when I got into real estate investing and what we're going to talk about today, this ultimate asset of infinite banking and permanent, properly structured insurance. And we'll describe what that means. And don't run away, because when people hear life insurance, like, there's no way. But we use it as a tool. The Wall Street Journal actually called this the tax shelter of the rich. We teach mainstream America how to use permanent insurance correctly as a guaranteed investment. We're not focused on the insurance. We're focused on maxing out cash value, creating more wealth. Then we teach you how to use this money tax-free to go buy more assets. That's the power.
Sounds amazing to me. If I'm hearing it the right way, it feels like my money's growing and then I'm getting to leverage money and not have to pay all these taxes on it. It sounds exciting. And I wouldn't click away if I started watching this right now. I would probably be a bad host if I didn't immediately talk about the elephant in the room, this ultimate asset. Can you guys explain in a little bit more detail what this ultimate asset is and how it works?
Well, Barry, let me take it for a second.
Yeah, Steve actually, I mean, he trademarked this phrase, which I thought was so amazing, this title, the ultimate asset. So Steve, why don't you dive into what it is, and then I'll add a few little tidbits as well.
All right. And there's some history to this that I didn't touch on initially. And it goes back to, I was probably your age, Andres, and I was sitting in my uncle's office. And my uncle was really had accomplished a great deal at Northwestern Mutual, which is one of the principal companies in this arena. We're not promoting them now. We're not really promoting any company, but we do vet our companies so we can get into companies and all that stuff. But the point is that he introduced me to this asset years ago, and I was intrigued at the time. I was a young guy like yourself, and So I first started to fashion this idea of life insurance as an asset at a young age. A lot of people think strictly of the death benefit. I'm just going to cover in case, I die or something. And most people don't like to think about that. They probably think about term life insurance or something. This is when you look at an illustration, you look at the numbers. I know Barry's going to most likely get into that a little bit. Here, you get to see a predictable growth of a nest egg, basically, that's happening and that's tax advantaged, and then you can use that money. So I know we're going to get into that. But the point is that when we're going to talk about the ultimate asset, and then that was planting a seed. It took me many years before I sort of circled back. But as an attorney doing trust and estates, I would come across people every once in a while that had a really mature high cash value whole life policy, and they loved it. I mean, it was their best asset a lot of times, and it just kind of triggered that memory for me. I was like, man, this would be cool to get into this area and tell people about this, because it's one of those things that goes under the radar for most people, most attorneys, even most financial people, for whatever the reasons, are not oftentimes up to speed on this asset. So you kind of have to do a little digging. There's some knowledge out there about the Rockefellers and how they carried on their dynasty using this asset. And you just have to you have to be an astute person to study this a little bit and understand it for yourself if you want to use it, because you're just not going to get it from the masses. So that's what I found as a trust attorney, and what propelled myself and my business partner, Jason, as well, just to learn more about this, what you can do with it, and bring it to the mainstream. Thereafter, we connected with Barry, and I'll pass the baton over to you, Barry, if you want to add anything to that, to my take and my experience on it.
Yeah, for sure. And I want to say to all your listeners, we keep it very simple. We're not getting into the weeds. We keep policy design very simple. So everyone out there, we believe if you have discretionary income, this ultimate asset should be a part of your portfolio. But why is it the ultimate asset? Think about this. If I said to you, I've got a product that's guaranteed to make money every year, you're not locking up your cash till you're 59 and a half like you would in a 401k or IRA. You can use all the money tax-free And oh, by the way, if you pass away prematurely, there's a permanent death benefit that can go to your beneficiaries. And this is what banks, major corporations, businesses, and wealthy people have done for generations. All your listeners are going to say, well, what is that? I want that.
Yeah.
It's the ultimate asset because it checks all these boxes. I've done this again for 25 years. I've never seen one product that does all this and more that we don't have time to get into today in one product, in one place. So if you're investing in the stock market, say a brokerage account, you might be able to get some gains on those stocks or the mutual funds. But I guarantee in a 10-year time frame, you're probably going to have 2 to 3 down years also. If you're putting money in the 401k or IRA and you're 35, you've got to wait 25 years to take that money out. Because if you try taking it out before 59 and a half, you're going to get hit not only with the tax, but also an early withdrawal penalty. The government locks you in. They don't want you touching your money till you're nearly 60. But here's the big thing. Those accounts are all taxable. And Andres, you and your listeners, do we have any idea what taxes will be 10, 20, 30 years from now?
No.
We're clueless. Why not build wealth 100% tax-free? But along the way, you're getting the guarantees, you're getting the liquidity. So me as a real estate investor, I take policy loans to go buy more real estate. I have clients that are business owners. They take policy loans to buy equipment or invest in their business. I've got young guys like you that are buying crypto. They're good at it. It's what they do, or they're day trading. So there's a lot that you can do. That's why it's called infinite banking, because it's really limitless on how you can use the cash value. But the ultimate asset, properly structured, high cash value, whole life insurance, it does so many things at the same time.
I'll jump in a little bit. So a couple principles underlying what Barry just said. Number one, the wealthy buy assets. I'm sure many of your listeners have probably, read some Kiyosaki, the wealthy buy assets. And so Barry's talking about using an asset to buy assets, using an asset that's already earning a compounding return, tax-free, guaranteed growth plus dividends. That's the lay of the land on that. So it's already earning, and then you're buying something, you're putting it into something you're good at. So your ROI or ROR kind of shoots up when you're doing it that way. So that's the exciting piece of it, at least for me. But here's the other exciting piece. I'm going to give you, since you're a young guy, Andres, I'll give you a little perspective. During the 2007, 2008, we're seeing a little volatility right now. So I saw chaos. I started a law practice in 2007. So when real estate just took a dive, if you had this asset, you're gonna have a reliable asset. You're gonna be stable somewhat, right? So we saw so many people that were devastated because they put everything in real estate. For example, a lot of financial people want you to put it, everything in the markets in some fashion. Maybe they'll say diversify with, bonds or something. But what we promote is true diversification, which is really a different asset that has its own characteristics, its own contractual characteristics. And the liquidity is just the icing on the cake because it's so flexible. So those are just bits and pieces I think that people should think about.
Yeah, and one thing that I'm thinking of here that might be very valuable for the people listening, they're all probably around my age, maybe a little older, maybe a little younger. I'm 26. I'd love to kind of workshop right now. Like, I think that I'm somewhat financially savvy for 26. I've got a good job. I've got multiple side hustles. I invest. I have a high yield savings account. I have a 401k, like all of the things that are told to me that are the right things to do. I've never heard of this. I've never leveraged it. Like, if you were just cold pitching me as a potential client right now, what would that interaction look like?
Yeah, I'll address that. The first thing we always do is we want to look at your own numbers. So I'd ask you, some questions. Annual income, how's your health today? I want to know more about how much is going into the 401k, the high yield savings account, discretionary income, debts, etc. Most people, they're looking at somewhere between 5 and 25% of their annual income going into a policy. So I've got clients all over the country. Some clients are putting in $500 a month. Keep it very simple, throw $500 a month into a policy. But I also have clients that are dumping in hundreds of thousands a year. So you get to choose the premium amount that you put in. But Andres, let me ask you this question, and your listeners as well. What do you have in your portfolio right now that's guaranteed, liquid, and tax-free? And most of you are going to say, nothing.
Yeah.
Right? But don't you want that? Like, we all want that. We all want tax-free. I go through this little exercise. If you picture 3 circles in your mind, and these circles represent buckets, tax buckets, the first bucket is your tax-deferred bucket. That's your 401k, your IRA, qualified plans. The second bucket, the middle bucket, that's your taxable bucket, like real estate or a CD or a savings account. You have to pay taxes on those things. Your third bucket is tax-free. Which bucket do you like the best?
I like the tax-free bucket.
And I've never heard someone tell me a different answer. So 100% of the time, you gave the answer that everyone gives. Well, here's the next question, which is very telling. Where is most of your money?
It's mostly in the market.
Yeah, mostly in the market, tax deferred.
Yeah.
See, we want tax free. Why in the world then are we putting most of our money tax deferred or taxable? And this is where we've gotten our education in the United States. We're being educated by Charles Schwab, Merrill Lynch, Fidelity, JP Morgan Chase, Ameriprise, right? Edward Jones, all these powerhouse financial institutions. And the reason we get the education from them is because it's controlled by Wall Street. And they know that the more money that they have under management, it's called AUM, assets under management, the more they earn in fees. So you'll never hear about this ultimate asset from one of those companies, because every dollar that you put into a properly structured whole life policy is a dollar that they're not getting to earn the fees off of. And Andres, here's what's crazy. When you lose money in the market, your financial advisor, those companies in Wall Street, they still made money. They're making money every year, even when your portfolio is negative, because of the fees. And look, I'm not saying don't ever invest in the market. Steve mentioned this earlier. True diversification is different asset classes, not just small cap funds and large cap funds and bonds and those types of things with mutual funds or individual stocks. That's still all market based. True diversification is different asset classes. It is market, 401k, IRA, whatever that looks like. Crypto is a new asset class that I think is amazing. Cash value insurance, real estate, a business, gold and silver, savings, HSA, right? High yield. These are all different asset classes. And we want people to truly be diversified. So putting numbers to it is really dependent on how you want to fund a policy. I tell clients all the time, get as aggressive as you can, because you can always go lower. The premiums are flexible, which is really kind of cool. But knowing that you're making money and growing money guaranteed every year, but you're not locking up your cash, you can put, a higher amount into it, knowing that you could have that flexible premium if you needed to. But I tell clients this as well. Don't think about this as a cost. Your traditional term insurance is a cost. Term insurance is like renting a house, right? You've got a 20-year term insurance policy, and if you outlive it, it goes away. It's like renting a house. And most people, 98% of people, outlive their term insurance. This is permanent insurance. So yeah, you get a permanent death benefit, but because you have all of those benefits of guarantees and tax-free use of your money, don't think about it like a cost. Think about it as an investment. We haven't even gotten into you using this as a tax-free stream of retirement income. That's a whole nother conversation. But it's amazing when you start looking at your own numbers. So that would really be the next step. Once you decide, hey, those numbers look good, I want to move forward, you do have to do an application. You do have to qualify. And that qualification can take 5 days, it can take 60 days. Once you're approved, then you make a premium payment, then you lock in the policy, you get online access to a portal. I become a team member in your financial organization, right, on your financial team. It's a long-term relationship, and we love helping people. We love helping people get proper financial education. Robert Kiyosaki in Rich Dad Poor Dad, I think he said it best: increase financial literacy. That's what we're really wanting people to go through, because we're not getting it. We're not getting it in school, and we're not getting it from Wall Street.
Hey, a couple thoughts too. As a young guy, Andres, you got a couple of huge advantages. I mean, you're making some money at a young age, and your cost of insurance is cheap. So, man, I mean, there's a lot of people that probably start this in their 40s, 50s and think, man, I wish I knew about this 15, 20 years ago. So I would just say, gosh, you're making money. You're a young person. A lot of things that, and I might sound like a jaded Gen Xer or something right now, but a lot of people want it now. They want to I want to put this money in this investment, have it erupt in value, right? And yeah, this is something you can say, wow, I mean, in 15 years, this is going to be nice. So you got that long threshold of time that this thing can just grow too. So you can maximize the cash and just have this nest egg, no matter what else you're doing, which for me as an estate planner, you're going to have this asset just growing. And that's such a great thing to do at a young age. Look at the long game.
Yeah, compound interest is the game for you, because you're earning a dividend that's reinvested. That dividend is now earning interest, and that happens every year. So the compound effect, that hockey stick, kind of slow in the initial phase, but man, it takes off. So let's say someone's putting in $1,000 a month into a policy. And by the way, you can also add an additional lump sum. Like you put in $1,000 a month, you're like, hey, I'm sitting on some cash. I want to throw an extra 25,000 or 50,000 into the policy, or 10,000, whatever that number is. The lump sums really help turbocharge the cash value. But if you're putting that 1,000 a month in, 12,000 a year, you get to the point in the policy where your 12,000 grows to 14, and then your 12,000 grows to 17, and then your 12,000 grows to 24. It doubles, and then your 12,000 grows to 36. It triples. So the compounding is huge. And you can only get true compound interest in a guaranteed product. If you ever hear a financial advisor, or you're looking at your brokerage account or 401k thinking, man, I want some compound interest, it'll never happen. The reason is because you can't get true compounding when you're in the stock market and you're dealing with volatility. The ups and the downs, the compounding is destroyed. So true compounding only comes from a guaranteed return.
One of the things that I'm just curious about, like listening to it, is obviously like the traditional person knows, like I can buy Facebook stock at $100, and if it goes to $500, I made $400, whatever percent return that is. When we're talking here, you're saying that these assets are compounding and they're growing. How are they growing? Like, what is the rate of return? How is that determined?
Yeah.
Those are a few things that I'm curious
For most people,
about.
and I'm going to keep it very simple because it is age specific and health specific and premium specific, etc. Most people are earning a 5 to 6% tax-free return net. And the reason I want to emphasize the two words tax-free is because if you're earning 5% tax-free, that is compared to earning 7, 8, 9% in the stock market, but never having a losing year. And we know the market does have losing years. So 5 to 6% net tax-free is remarkable in a life insurance policy because it's a sleep well at night product. You never have to worry about losing money. It's on autopilot. And then that 5 or 6%, now it's compounding. So that's probably the way to think about it today. This is the steady investment. This is that part of your portfolio that you don't worry about. guarantee, liquid, tax-free. And then you've got other money elsewhere, which we talked about is giving you that true diversification.
And yeah, go ahead, Steve.
Just to add to what Barry said. So I love one thing I really enjoy when I see somebody do an illustration, when Barry does it or whatever, is you can see your ROR on the illustration, and what it will do is it'll be real small at first as things grow. That ROR will increase over time, and I always love it. When Barry points out the fact that ROR that you're looking at, if you were to look at your own numbers, would be for every year. So when you see, when you go down the column, you'll see, okay, well, by the time your policy's matured, you're going to see that you got that every year again. So there's power to that when you see those numbers. The other piece of it for you as a business owner is, I think, you want assets on your balance sheet as a business owner. So you're building your business and you might be expanding and doing different things. The big companies the big banks, they've got a huge portfolio of life insurance. If you look a lot of times on their balance sheet, this is something down the road that you'll be able to use to expand and these kinds of things. And that is a whole other video probably as well. But to me, as a business owner, I'm thinking again, where you are now, where you want to be 15 years from now. You can even have the business own it. There's different ways to structure it.
Yeah.
And have it on your balance sheet.
Like real estate, let's say you buy a real estate property for $500,000 and over time it grows to 1.5 million. So you've got $1 million of equity in this real estate property. Until you tap into that, it's just this hidden potential, right? Well, that equity is an asset that you could then go put to work. You could do a HELOC, you could take a second mortgage, whatever the case might be, and you can tap into that $1 million to go buy other assets. This life insurance policy is the same thing. So over time, if you put $500,000 into a policy, you could do that all at once, or you could do it over 20 years or 40 years, whatever. But as it grows and you have all that equity, which we call cash value, you're putting that to work. We want to encourage you to put that to work, because now you can go buy other assets and you didn't pay a dime of tax on any of those gains. Here's the best part. I want your listeners to really perk up with this. This is a golden nugget. Let's say you've got $500,000 in cash value and you take a $200,000 loan for a down payment on a real estate deal, whatever you want to use the money for. The insurance company doesn't physically remove the $200,000 from your $500,000 cash value. You're still earning interest and dividends on the total $500,000. So for me as a real estate investor, I'm now making money in my real estate deal, and I'm making money on my total cash value in the policy. Two places simultaneously, I'm still growing wealth. Yeah.
That's amazing. And when you borrow that 200,000, what does that look like from a interest standpoint? Because it is technically your money, but you're kind of taking it out. So what does that look like?
The life insurance company really does give you a loan from their general account, which is why they're not physically removing that money from your policy. Loan rates today, 5 to 6%, depending on the company we look at. But remember, you're still earning 5 to 6% inside the policy. Well, at face value, it seems like a wash. It's like, okay, I'm paying 5 or 6, I'm earning 5 or 6, it's a wash. No, it's even better. And the reason it's better is because of this. When you take a policy loan, we encourage people to be an honest banker, pay your loans back, get in the habit of being an honest banker. Every month you pay that loan back, the balance of the loan is going down, which means you're paying less interest over time, right? That policy cash value, however, it was still compounding on the full amount. So when you compare the two side by side, and if you go to our YouTube channel, Insurance and Estates YouTube, you'll see we've done these policy loan videos. But when you compare compound interest to principal reduction, even though the loan rate and earnings rate might be the same, you still come out ahead dramatically because of the compounding.
Yeah,
That's
and
awesome.
my favorite thing about policy loans, though, as a business owner, is that they're also entirely flexible. So if you don't want to pay it at a particular time, maybe you're using cash for other things or whatever, you don't have to. It's something that comes out of your death benefit if you don't pay it back ever. And this is a little hint for the tax-free retirement. That, a lot of times people just schedule out. At a certain age, they'll start taking tax-free withdrawals for retirement, tax-free retirement monies, and it's just not. They don't intend to pay it back under that kind of a structure. It's just going to be drawing down somewhat on that death benefit. So you can structure it however you want, but again, a lot of flexibility there.
That's awesome. One thing that I thought would be just interesting to hear from both of your perspectives is you meet with all of these people. What is the biggest financial wealth building mistake that you see most people make? Because maybe we can help some people
Steve,
avoid
you want
that.
to go first?
Good question. Wow, that requires some thought. I mean, I've seen probably thousands of estates of all kinds, and you see people with a lot of money, a lot of assets, and you see people with next to nothing in their 70s, right? So, and I think, to me, I think it has to do with having a rather conservative, content approach, taking risks, taking calculated risks, but having a methodical approach, right? So if you're a stock trader, obviously you're not going to put all of your money in the stock market. You have some other assets. I feel like you need fallbacks. You need to account for fluctuations. And so the people that I've seen do the best either have the best planners that help them do that, or they're just very methodical people. I know that's a little bit intangible how I'm saying that.
But you're an attorney.
People that invest in themselves and do what they're good at, are able to do what they're good at consistently over time, seem to do very well. People that get carried away with the whims of things. I saw a lot of people crushed when everybody was jumping into real estate. When they didn't really do the homework. So I think people need to do their homework. I think they need to do their homework on this. They need to understand how to use this asset. I think people need to think about somebody younger in your position. Andres, just think about having true diversity, like I mentioned, having things kind of organized so that if you do have a downturn, you're going to be okay. And in the meantime, you're fueling up doing the things
Andres,
that you're good at.
I'd mentioned too, the biggest financial mistakes that I've seen, number one, is people not taking action. You're not going to have anything in the future if you're not putting anything aside. And I've had people say to me, I just said this to a client this morning because they said it to me, at least once a month, usually once a week, someone saying to me, Barry, I wish I would have done this 20 years ago. So Andres, you're that guy. You're the guy they're referring to, right? They wish they would have done this 20 years ago. So not taking action. The other biggest mistake I've seen people make financially is they get scared, right? Even if you do have a market-based account and you see the market going down, that is not the time to be taking out the money. Ride the storm. Ride the storm,
Yeah.
push through. There's something called dollar cost averaging where if the market does go down, for me, I start to buy. That's what I do. I want to buy.
Yep.
Where other people, they're getting emotional, they're selling, and they're taking realized losses. We don't want that. Be patient with the process. Even with this asset, be patient with the process. We're going to show you how to use it as soon as 30 days after you start a policy if you want. But those mistakes can be crippling. People must take action. And if you want a better future, my question often is, what will it take? What will it take for you to get there? And then put those pieces into motion and take action.
Okay, so now Barry jarred my thinking a little bit too. And make sure you got to vet your advisors. we're in a time that's so competitive. You know this as a young guy, Andres. So you're gonna get a lot of advice. You're gonna get, and I can give you an example. I had a chiropractor. He had a policy. He had cash value in it. Seemed like he didn't understand it very well, and he was going to cash it in because his advisor said that he could get a better return somewhere else. So, and why, so you got to kind of weigh that kind of advice. Like, and I would say do that with us as well. You got a couple of attorneys. You got Barry, who's been doing this for 20 years. Vet your advisors. Figure out why in the world someone would be giving you the advice that you're getting. Is it based on conviction and what's good for them? Or is it based on just turning a deal?
And we would encourage. So Steve's got a book called The Ultimate Asset. I've got a book called Live Rich, Die Rich. Get financially educated. Read the books. Read Becoming Your Own Banker by Nelson Nash. Watch 5 or 10 or 20 of our videos at insuranceandestates.com or the YouTube channel. But also look at what others are saying. And we like questions. Like this chiropractor that Steve mentioned, he's saying, well, my advisor says I'm going to get a better return. Well, maybe, right? Maybe, we don't know. It's like anyone can use that blanket statement. But the reality is most people in the market, and I've analyzed hundreds of portfolios and illustrations, most people in their 401k, IRA at the end of the day, after the volatility, after paying the taxes and dealing with the fees that are going to the money managers, they're only netting about 2 to 3%, which is, it's pathetic, frankly, because they've taken all the risk, they've put up all the money, the money managers made money every year, now they're into retirement, they've got their 401k, IRA, and Social Security, and they're saying, why don't I have more money? Like, what's the problem? And all the money that I do have, it's taxable. This isn't what I was expecting when I got to retirement. We're saying there's a better way, and you should get educated about that better way.
Yeah, and if somebody does have a policy, Barry does regular policy reviews for people. So if you have one, you're not sure about it, we do give an honest answer on whether it was designed well. And I know from experience with Barry that we wouldn't touch it if it was solid. If it's not, then we give feedback on that. So
awesome. And I want everybody listening to make sure to check out both of those books, because I know that there's a ton of value packed in those, and we'll link those in the description wherever you're listening or watching this interview. One thing that, again, another thing that just kind of caught my mind here in this conversation, I have a newsletter with 20,000 subscribers. It's mostly founders and CEOs on there. And I actually talk to a lot of business owners that are around your guys' age. And they're always trying to understand how to keep up with the pace in business now and keep up with the younger generation. Both of you have gone as far as having a YouTube channel and creating content and creating videos. I'd love to know just firsthand how that's affected your business and helped you be successful.
It's everything. Yeah.
Yeah. I mean, we're an education-driven business, right? Where the strategies that we've touched on here are basically all we're doing is giving a little bit of information here, and then someone that really wants to know about it would probably next dive into some videos on the YouTube channel, which is what we want, or on the website. We have tons of articles at insuranceandestates.com that are actually super in-depth if people want to read an in-depth article. But YouTube, and we do have some other social media as well, but those are the main two that people tend to gravitate to.
Your generation, you guys barely know what a phone book even is, right? People are not going to the phone book today. They're going to Google. They're going to YouTube. This is where we're consuming our education, TikTok and Instagram. So the business owners that are listening to this, take the leap. Take the leap and start one social media channel. It could be any of those: Facebook, Instagram, YouTube, TikTok, LinkedIn. Do something and begin putting out your own education about what you do, about yourself, about client stories and case studies, or maybe you're in the business of creativity and show people what you're doing or whatever it might be. But get started. Don't fear it. I've learned that fear comes when you don't know about something. But as soon as you learn about it, that fear diminishes and in most cases go away. I remember my 15-year-old daughter, I asked her what she wanted to do for her 16th birthday. And she said, Dad, I want to go skydiving. And, I've got 5 children. And I was like, let me think about this. So I decided, because I have my planning in place and multiple policies for life insurance, that I was going to go with her. So we did. Took her skydiving, and it was incredible. Everyone should go skydiving. It was just so amazing. But the fear wasn't there for me. Why? Because I learned about it. I knew my plan. I knew the instructor and his, thousands of jumps and everything else in between. But I'll tell you, my daughter jumped first, and I'm looking at this ball in the sky, 14,000 feet in the air, and thinking, oh my gosh, my daughter is falling from an airplane right now, and I'm on the ground watching her, crossing my fingers, praying, hoping everything that's okay. But fear can be diminished with education. All your listeners that are not yet on social media, you're going to get left behind. There's a great older book called Who Moved My Cheese? Probably heard of that book. If you don't move your cheese, you're going to get left behind. So be innovative, be aggressive, get something started. Don't fear social media. It's where it's at, and it's where it's going to continue to go, especially now with AI. It's huge.
Well, and Mary mentioned planning, having his plan in place. We really haven't talked about legacy or death benefit or any of those things at all. And as an estate planner, I'd be remiss just not to say those are huge components. We do have some trust planning ability to help people with that as well. If people, you might even be a little before that point, Andres, unless you're getting started with the family early. But anybody that has kids, or people that they want to provide some assets for, if they do meet their fate, skydiving or whatever it is, the trust is a very critical vehicle for that kind of thing. I know that's another topic.
It is another topic, and let me just add my 2 cents to this. It's hitting home recently for me because in the last 4 months, very recently, I've had 2 more clients pass away. And guess how old they were? One was 39. He was a physician, dropped dead of an aneurysm. The other one was in his 40s. So these are young people that did not plan passing away at 39 and in their 40s, but they did. They took our advice. They had the planning in place, the trust, those types of things. So if you are listening and you're a business owner, you think, oh, I'll take care of that someday. There may not be a someday. Take care of it sooner than later, because you don't want your assets going through probate. You don't want your family dealing with all these bills because they don't have enough cash to pay for things. Life insurance, which we're not really, we're not talking about the life insurance per se. We're talking about more of these living benefits and infinite banking. But the life insurance component itself is huge. And this is how families like the Rockefellers, like the Kennedys, like the Rothschilds, and even people you know of, Walt Disney and J.C. Penney and Ray Kroc of McDonald's, they all used cash value whole life insurance to their advantage. And it propelled their family estates even greater.
Yeah, and not really a day goes by for me personally where it's in the back of my mind that if something did happen, that my wife and daughter be taken care of here, and so there's just something about that, as well, from a peace of mind.
Yeah, I think peace of mind is always important, and I think one of the main kind of, if we wanted to sum this conversation in a really simple way, it's just take action. everybody that's not taking action across all of these different things we talked about is getting left behind. And I feel like this is something that we could talk for 2.5 hours more about. And unfortunately, we don't have the time for that. So I'm going to make sure that in the description, the YouTube is linked, because anybody that's curious, anybody that's brains turning during this conversation, go to the description of wherever you're listening this and go check out the YouTube channel that they have and go and educate yourself. I'm usually not so open to just plugging, but if this is something that's going to change people's lives, add a ton of value, I think it's really important. I always ask the same question at the end of every interview, and it's fun when I have two people because that means I get two answers. But it's very simple, one of those cliche questions, and it is, if you could go back and talk to the 18-year-old you, what would be the one piece of advice you'd tell yourself?
Go for it.
You want me to go first, Barry, again? In line of what we've been talking about, I think that I would have advised the 18-year-old to start a policy immediately and just stick to it and never pay in the premiums for as long as, I need to pay them, and then never touch it. As from a financial standpoint, I think that would be.
And I'm going to say two things. One, yes, start a policy. I wish I would have started a policy at 18, but I would have taken more risk in the real estate world. Like the fear, right? The fear at 18, and I remember being in my 20s, which isn't too far away from 18. I had an opportunity to buy a real estate rental house in a college town that I was living in, and I didn't pull the trigger. I had the money, but the lender came back and said, hey, you already own your own home, and the interest rate on this rental property is going to be higher than what we told you and what you thought it was going to be. Well, that fear of like, oh my gosh, the payment's going to be higher, is the property going to cash flow? And it still would have cash flowed. It still would have worked out. But I let that fear overtake me. So talking to my 18-year-old self, I would say, don't be fearful. Take some risk, but get educated about the risk. Because now I'm 55, feel like I'm 35. But all these years later, I think about what would my net worth be today? What cash flow would I have today greater than it is currently? So starting young is huge. And I'll tell 18-year-olds or 20-year-olds or 30-year-olds, you can accomplish whatever you set your mind to. I know it's possible because look around, right? You see the skyscrapers in the sky, and you see these business owners and all these people that have success. It's all possible. But you said it. You've got to take action to make these things happen.
100%. Well, Stephen, Barry, this has been an absolute pleasure. One, I got the chance to learn and now potentially make my life better down the road, but a ton of other people will receive the same value when this episode goes live. So I do appreciate you guys coming on here and showing us about this whole other world. I haven't had a conversation like this on the podcast, and I always love when I can bring a unique angle to our community. So I do appreciate it.
Likewise. Thank you, Andres. Nice to be here.
Yeah, of course. And for everybody that is still with us right now, make sure to hit the description and go check out Stephen and Barry's links. Go connect with them. Go reach out. Tell them Beyond the Wealth sent you. And again, Stephen, Barry, thank you for coming on the episode. And we will see you all on the next one.